You're about to hear from brothers Eric and Jack as they exchange ideas and learn from the most calculated real estate entrepreneurs in the business today. This is Tangible Assets, the new rules of real estate. Hey, what's going on, everybody? This is Jack Eichhoff, co-host of Tangible Assets, here with my brother Eric Eichhoff. We are super excited. We have our guest, Drew Whitson, with us today.
Hey, guys.
And,
Thanks for having me.
Yeah, absolutely. So, let's get it started. So, Drew, tell us what you're up to. How are you involved in, real estate? And give us a little background what you're up to.
Sure. So right now I'm spending a lot of my time investing in larger multifamily apartment buildings, multifamily assets through a syndication structure, which means that I work with a group of investors. I have a group of specific investors. Sometimes it's one investor, sometimes it's a large group, and I work with them to acquire large multifamily assets that we believe either have a lot of opportunity and potential, assets that we believe we can reposition, and to have a really great risk-adjusted return for our investors. I started out working here in the Twin Cities, a decade ago. I was doing single-family homes, and 5 or 6 years ago, one of my best investment buddies and we decided to buy a multifamily unit, and we bought a fourplex. And we bought it up in Forest Lake, which is just half hour north of St. Paul. Mm-hmm. And we were so excited. Like, we just couldn't sleep the night before. And it was just, we thought we were just the biggest deals in the world because we got this fourplex up in Forest Lake. And it was great. We learned a ton about it. But we learned a great lesson from that was just a couple months after that, we bought a 32 unit. And what we learned from that process was that the process of buying a 32 unit was actually a lot easier than buying this fourplex.
Interesting.
Yeah, and for a couple reasons. One was we went with a local commercial lender who understood multifamily assets, and they really wanted to underwrite the value of the building. They wanted to know us, but they really were underwriting the asset versus this fourplex. It was really the bank underwriting us, and it was a really difficult, arduous, paperwork, time-consuming process with Wells Fargo to buy a fourplex. But we used some of these great local banks in the Twin Cities here and acquired this 32 unit. So it was sort of opened our eyes to be like, hey, let's just kind of do bigger assets. And sort of since that time, we've been continuing to expand on that asset base and in our knowledge and our investor network to where we're at today.
Yeah, that's awesome. So you bought your first single family, and then how long until you bought that 32 unit?
It was a couple years. It was probably 3 or 4 years.
Okay.
I really bought at the dip of when the single family homes kind of were crashing.
Yeah.
Back in 2011, and basically anyone that I bought, when I was telling people I was buying and investing in real estate, they thought, that what a great way to lose money, right? There wasn't a lot of people that were sort of super supportive of, because at that point in time, vacancies kept going up, and but the prices kept dropping. I mean, it was just kind of this massacre in the single family home market. Yeah. But I'm a finance guy at heart. I got a degree in finance. I'm a corporate finance background, and I looked at the math and I saw these property values going down, but the return kept going up, right? The rents for these assets kept going up, even though the prices kept going down. And so I was looking at the math saying, this is just magic. I mean, the kind of returns that you're getting just on a cash basis were just incredible. So I was buying into a math problem, a financial solution. I wasn't buying it just based upon kind of the whim of the market, or kind of what the common wisdom was around what was going to inevitably continue as a downturn in the single family home area.
Yeah, so like these buildings, like from a comparable sales approach, their values are dropping, but the financial or the income approach, it just getting sweeter and sweeter. That's awesome.
It looked great. Yeah.
Yeah. No, I totally get how that goes. So were you buying these ones with partners like from the start, or did you buy your first single families yourself? Or
my single families were myself.
Yep.
They were just houses in my own neighborhood. In fact, the first single family home I bought was the ugly house directly across the street from me. It was the one ugly house on the block, and it went into foreclosure, and I just wanted to buy it to resite it. I hated looking at it. It was this ugly mustard yellow, 70s built with brown aluminum awnings. It was awful. So I bought it purely just because I didn't like looking at it every morning when I got up. I put some tenants in there. I got it fixed up. I put some tenants in there. And after the end of that first year, I sort of thought, what a great year it's been, right? The property went up in value. I was able to get a second loan and extract some of my original capital into it. My tenants were paying on time. They were covering all of my expenses, and I had a pretty nice paycheck at the end of it. And so I said, why don't I just hold on to this thing? Like, let's just sort of see what happens. And I kept those tenants for 4 or 5 years. And at the same time as these properties started to go into foreclosure around me, so I bought the house, the house, 2 houses down from me. I picked that one up a couple years later. And so I used to have a joke that I would only buy a house if I could hit it with a 5-iron, and I'm a really, really bad golfer. So I owned a lot of my own neighborhood just because, buy what you know. And I didn't know real estate. I didn't know. All I knew was that I could buy these specific assets at a certain price, and I was very confident what it took to turn them, get them up to a good rentable condition, and I knew exactly what the rents were. So I wasn't experimenting in other markets. I was just buying literally if it was, on the street I lived in or an adjacent street. It was very, very close.
And you were in corporate finance at that time.
I did. Yep. I worked a corporate finance job in downtown Minneapolis, and so this is just kind of something I did on the side. But one of the things I really learned about I think that's been a good lesson for me today, is that I really try to delegate a lot of the work. Right? If I tried to do everything myself, I would never be able to expand my portfolio. It's only when you're able to find good people that you trust, that you want to delegate that work to, are you actually able to expand your portfolio. I have some friends who have just a handful of properties, like a 4-plex and a couple duplexes, and they're so busy they never have time to do any more deals. And I say, well, you just gotta hire someone. And they say, well, I can do it cheaper than I don't want to pay someone to paint, or I don't want to pay someone to do the plumbing, right? But they're sort of stuck because they haven't delegated. And that's why they're stuck at a half a dozen units, and I've got over 2,000 across the country, because I've been able to delegate and find good people to trust. Because the best use of my time is, how do I build a great investor network? How do I build great deal flow? And how do I manage the existing assets I have without actually doing any of the work? Finding those good partners that I trust.
Yeah. Wow, that is quite the stack of units you got there.
Yeah.
Yeah, and so for our listeners, Drew introduced himself and kind of his background, but if you think you've heard his name before, that's because you probably have. So Drew was a speaker earlier this year at one of our events, actually back in 2019. 400 units by 40, and I think we could have we had a sold out packed house event. It was amazing. You're coming back in to speak at another one of our events in the near future here, but what was interesting about that was 400 units by 40, and we probably could have even added to that title like within 4 years, right?
Yes.
Wasn't it? Yeah.
Yes.
And
400 units in 4 years. Yeah. And not sort of sold me out. I'm 40 now, but yep.
Yeah. And so it's what's interesting to me is, there's so many people are like, real estate's interesting, but it's not 2011 anymore. It's not 2012.
Yes.
And what would you say to someone who doesn't have the opportunity to buy a deal like you were able to buy back then?
Sure. Well, I think there's two different ways that you value assets, right? One is the single family home, which most people are familiar with, and the value of that house is based upon what else is sold. Right? It's the value, what did my neighbor's house sell for? And if you only look at that, now is a really tough time to buy, because we had this big, fantastic dip. That's what I sort of got in. But the prices of single family homes only are only going to be reflective of the comps. What I really like about multifamily apartments is the fact that I control the value of the asset, right? It's not contingent upon what did the apartment building across sell for. It's what is that stream of income worth? Right? And I control what that stream of income worth is. And so if it generates a certain amount of dollars, it's worth a certain amount. So that's why you can have two identical buildings in the same neighborhood, and one is worth significantly more than the other one, is because it generates more cash flow. So I'm not subject to the whims of the changes of the market. I'm not as nearly as subject to valuation changes based upon interest rates, right? I control that, and I get to make a lot of decisions in terms of how I can create value. How do I grow that value of that asset? And that's what I love about multifamily, is I can take properties and I can make some significant improvements. Either I can have rents that could be raised, which we can get into. That's my last thing I like to do, right? But I can manage expenses. I can reduce the risk. I can do some deferred maintenance. I can reposition the asset. And so I have a lot of control over the value of that asset, and I'm not subject to sort of what is the market. Is the market going to go up or down? Frankly, it doesn't matter to me in apartment buildings, because I control the market and I control the value.
It's going to be a lot more consistent, yeah.
Correct.
I get that.
Yep.
I get that. Okay.
So what are some of those favorite levers that you have that if you're going to control and dig in and share, maybe a story or an example of how you've recently done that.
Sure. So I'm part of an investment group that purchased a several hundred unit up in the Brooklyn Center area. I'm sorry, Brooklyn Park area.
Okay.
We bought it about 2 years ago. And one of the things that we noticed with this property is that we bought it as a stream of income, right? It had a specific capitalization rate, but we noticed that it was run in a very old school manner, right? There was probably a maintenance staff or on-staff site of like 6 people, okay?
Wow.
Huge payroll. And when you look at the budget, you're like, well, the property's pricing out in a way that reflects that expense structure. And one of the things that my partners and I were able to do was after we acquired that, we really leveraged a lot of fantastic technology in order to reduce that payroll. So in going from a staff of like 6 full-time people, I think it's down to like maybe 2.5, more or less. So, and if you scrape out a huge amount of expense, right, that dollars shift right to the bottom line, right? It shifts to what's called your net operating income. And that's on a dollar for dollar basis. So those expenses can fall right to the bottom line. And if you think about extracting $100,000 of payroll out of your property, if you're at an 8% capitalization rate, you're talking like $1 million of incremental value on the property because you've increased that stream of income. Yeah. And you've not done anything with maintenance. You've not done any deferred maintenance. You've not done anything with rents. You've not renovated any units. You've purely immediately extracted expenses out of the P&L, and it creates more value. And so the great part of the story is, so we bought this about 2 years ago. We bought it for about $12.5 million. We just did a refinance 2 weeks ago at a $19.5 million valuation. So we created, nearly a 50% increase in the value of that property. But if you look at where that increase came from, most of that value increase came from our ability to lower the expenses on the property. Maybe 50% of that increase came from expense reduction. Maybe 25% of it came from revenue increases, and maybe that last 25% came from deferred maintenance. We were able to lower the capitalization rate, the risk profile of the property.
So just so we can explain this math and have our listeners understand, like an easy example, if it's a 10 cap, so 10% cap rate, and you're able to reduce expenses by $100,000, add that to net income, you take 100,000 divided by 10%, so 0.1, and that increases the value of your building $1 million. So,
correct. Yeah. The cap rate is essentially what are you willing to pay for that stream of income, right? Mm-hmm. So you can have, again, 2 identical properties. Both of them create an identical stream of $1 million of revenue. If you have a high-risk property, meaning a bad tenant base, you have deferred maintenance, I might not be willing to pay as much for that $1 million stream of income as I would for a $1 million stream of income that has been renovated. It has a good tenant base. It has good units. It's in a safe location. So just because you have identical streams of income doesn't mean they're equally risky. And so you might want to pick one over the other depending on the risk factor. And that's what we'd call your capitalization rate. What are you willing to pay for that stream of income? And that same stream of income can have different values.
So you can buy a riskier building, let's say with deferred maintenance at 8 cap, renovate it, compress it down to 6, and sell that to someone else. And now building's worth like 25% more, whatever.
Yeah, I recently did that. I bought my business partner and I bought a 9-unit building over near the new soccer stadium. Mm-hmm. And we sort of pulled all 3 levers. Like we renovated all the units, and so we ended up with higher rents. We ended up with lower expenses, and we addressed a lot of the deferred maintenance. So we were able to reduce the raise rents, lower expenses, and reduce this capitalization rate. And so within about 18 months, we were able to about double the value of the building because we pushed all these levers at the same time in order to try to create value out of the asset.
And you just can't do that with smaller duplex or single family, obviously.
No,
there's not valued on that basis. Yeah,
very little. And there's not very little. I mean, sometimes if you can, the way to make money in those kinds of assets is going to be, can you acquire them at a sub-market rate? Can you get them from in a distressed state? Do you have a desperate buyer? Do you have some really sort of difficult things related to the property that might be most buyers don't want to solve? Is the basement flood? Is there, right? So you might be willing to solve some big problems, but again, it's sort of like doing arbitrage, right? You're just kind of like it's sort of like you're just kind of solving one problem and getting the property up to the market. You can't go above that. You can't go above the market. Versus multifamily it can be worth whatever you want depending on the strategies that you employ in order to create value for your investors.
How many units does a building have to have for it to be valued purely on the income approach?
Probably, I think just based on sort of most commercial valuations, it's going to be above 5 units, right? Okay. I think 4 and below, you guys probably know this better than I do, but 4 and below, you're probably going to be kind of anchored in some comps. Like I think in terms of when you get an appraiser, they're going to look at the replacement approach, which usually gets thrown out because the replacement's very expensive, right? There's an income approach and there's a comp approach. My suspicion is most 4 units and under are going to be kind of based on the comp approach. Above that, you're going to end up with more of an income approach. Now, the one exception to that would be if I bought a 10-unit building in St. Paul, and on each side of me, there's a dozen 10-unit buildings also, right? There might be some comp approach to that, right? They're not going to give you a double the value of this property if everything else is worth half that. So I think 5 units and above is generally going to be a good metric.
Yeah. How long does it take you, let's say you are going to buy a building and you're going to flip it, how long does it take you to change some of these metrics? What kind of runway, for example, I have a 24-unit building that we're in the process of selling right now. If I wanted to drastically increase the value of it, how long would it take for you to come in and do that?
Yeah, a year is probably a good amount of time, right? A year gives you a couple things. It gives you, one, a chance to cycle through all of your tenant base, right? Because if you buy a property today, there's a chance someone signed a lease 2 weeks ago, right? And they're stuck in there for a whole year, right? So probably a full year is when you're going to need to have enough time to turn over the tenant base, which means it gives you time to cycle through and renovate all the units. It gives you the right amount of all 4 seasons in order to say, hey, let's tackle the roof, let's tackle the boiler, let's tackle the parking lot. So really that first year is going to be the key in order to create the most amount of value. And then usually after that first year, you want to get a nice clean historical financials in order to base the new valuation off of. Most of my assets I don't sell. Most of the time we buy these assets, we're able to increase the value, and then we can re-lever them up 18 to 24 months after purchase. Again, that first cycle is when we get the property sort of repositioned. That second year is when we get a nice clean historical financial record, which a lender could look at now and say, based upon these new financials, we would underwrite this to this amount, it would support a higher level of debt, and then we can extract our original capital out and return most, or if not all, of our investors' money back to them.
So you're telling me you haven't just been saving 20% down for all these places?
Not a chance. No, it's this velocity of capital. It's funny, if I go back to say my very first house across the street.
Which how long ago was that?
12 years, I think, my first year.
Yep.
I bought that one, I fixed it up. 6 months later, I got a line of credit against that one. That line of credit I used to buy the second house, got that fixed up, got a line of credit, and continued to that same capital got recycled over and over again. As you get through, you buy these assets, you can have them appreciate and then extract the capital. So it's hard to say, but I'm sure that same original dollar that I started out with, which was a really hard dollar to get, right? It was credit cards, I cashed at retirement, I borrowed money from my grandma. That first sort of nut of down payment was very difficult to get to. But after that, there's this velocity of capital. Instead of having to have more money to invest, you can really start to use a very deep and diverse balance sheet in order to go after new assets. Sometimes you can sell off smaller assets and do a 1031 exchange, or you can just go after that same capital that exists that you can extract and sort of reallocate. You lever up, increase your returns, you keep your investors happy, and then there's sort of this snowball effect that seems to happen as you get continue to get deeper into this business.
Yeah. So I've heard you say a few times, you got to keep your investors happy. I guess most of these people are going to be, investing themselves who are listening. So tell me, what are you doing with your, syndication deals, and I guess what's that look like?
Yeah. So one of the things that I talked about that 32 unit earlier. Yeah. My business partner and I kept trying to buy more units, but it turns out we ran out of money pretty quick, right? We don't have an infinite supply. And even with using a velocity of capital, our own capital, there's still an amount of patience that has to happen. And so we stumbled upon what was called a syndication structure, which is it's a limited partnership structure where my business partners and I act as the general partner, and we attract investors to say, look, we've found some assets that we think have a lot of value. We have a strategy. We have a good history of working in this asset class. We would like you to invest your money with us, right? And here's how we underwrite the deal, here's the risk, here's the opportunities. And so we've sort of slowly collected investors who are interested, who have the capital but don't have the time to invest in multifamily real estate. And so these investors come in, we can acquire an asset, and if they make money, if they make a lot of money, we'll make a little money, right? That's how we do it. We want to give our investors a really fantastic risk-adjusted return. The short, what we tell our investors is we want to double your money in 5 years, right? And our history is that we've been able to do that usually quicker. But that's the conservative position we want to take is, look, if you have capital, we want to give you a good risk-adjusted return that's above what we think you can get on average in the stock market. And so far, we've been able to achieve that through a sort of very careful due diligence process, very thorough attention to the management of our existing assets, and trying to be very strategic about when we acquire them, when we refinance them, or when we sell them. And so far it's been good. Our investors have trusted us, and we do a couple deals, but there's a lot of deals we don't do. The deal funnel gets very narrow at the bottom.
Yeah. How do you manage between, and maybe you have a partnership with this, but analyzing future deals versus managing your current portfolio?
Sure.
Does that get tricky?
Not necessarily. I think really the work of buying these assets, it comes at the beginning, right? It's if you have done your due diligence, meaning you know your market really well, you know what your improvement plans are going to be. You have a sense of what your new rents and expense structure is going to be, and you have really, really trusted partners that will do this on your behalf. Means you have a really good asset manager, you have a really good property manager. You basically do all the work up front, and then you just kind of launch the ship, right? You just kind of launch it, and they take care of it. And of course, you have checkpoints, you have reports, and you have financial reviews. But really, kind of the ship gets launched once you close the deal, and then you execute all those strategies. So it comes down to, do I trust my property manager? Are they delivering on the results? Am I doing the things that make them accountable? And do I have the right asset manager in place that's working on behalf of the ownership group to make sure that the plans that we have in place get executed? And if they're not doing it, then we replace them and we find someone that does that. Right?
Yeah.
So you make money in the buy, right? You make money when you buy it. The trajectory of your deal can change a little plus or minus, but it's really the plan you have at the beginning that really sets the tone for the return on the investment.
Explain the role of the asset manager.
Yeah, sure.
Do they live in So, and just to back up for a second, you don't only own property in Minnesota, right?
Correct. Yeah.
Okay.
So I started out in Minnesota, and I have several hundred units here. But over the last 3 or 4 years, I've really expanded, specifically through the Mid-Atlantic area. So Memphis, Little Rock. We just closed a deal in Huntsville. I've got some smaller deals out in various parts, smaller deals in the country. But kind of that Mid-South market is really where we've been spending most of our time making new acquisitions.
Okay. Yeah. So the asset manager, do they live in those markets, or are they local here in Minnesota with you?
Our asset manager actually lives in Texas, but great. He visits the properties every single month. He's sort of on site. He is a person that we've sort of released him to work very directly with the property management company. He works directly with some of the on-site staff in order to implement some best practices. This is the person who will help us coordinate secret shopping, right? We want to have people that make phone calls and record them and sort of get an experience for the ownership group to say, hey, here's what my experience has been. And then he can work with them in order to improve how they manage the tenants, what are the software and tools that they use. They can be another sort of set of eyes for the ownership, because I can't go see all my properties every month, but he can. And he can help manage some of the larger capital expense projects and kind of use his experience in terms of getting an asset into a place where that is performing at the level that we need it to perform to hit our return requirements. So it is a vendor service like anyone else. It's someone you can hire and fire. Sometimes that person is in part of the ownership group, but not always. Most of the time it's a vendor. It's a third-party vendor that we hire in order to manage these large, complex assets remotely when we can't do it ourselves.
At what scale do you need to be at before hiring an asset manager starts to make sense?
Yeah, that's a good question. I would say probably once you get closer to, well, there's two components of that. How close are you to the assets, right? And how much time and sophistication do you have in terms of executing these plans? Probably 1,000 units is probably about right. Like, maybe units might be a not a good metric, because a unit in the Twin Cities is different than a unit in Memphis and is different than a unit in San Diego, right? So unit might not be the right term, but these are well compensated people, and if your organization supports it, you could probably get away with 5 to 800 units. Should generally support a full-time asset manager.
Wow. And so I'm also curious, like, what are the specific indicators or triggers that you see in other markets that makes you say, oh, wow, this looks like an attractive place to invest in, long term?
Sure. Yeah. So there's probably like 3 or 4 major components. I think one is that market, is it business friendly? Like, is there an encouragement that we want, that the business leaders and the area wants people like me to come in and do housing redevelopment and sort of improvement of the housing stock? And a great example of that is Memphis. In the Memphis market, it's incredibly friendly towards business because Memphis has a high renter base, and they have a very old housing stock. And so there's a lot of tax incentives for people like me to come in, buy multifamily assets in their market, and then reinvest in them. And they provide me some tax credits in order to do that, in order to just improve the housing stock and quality of their of the apartment base in that market. So one is it a pretty business friendly or landlord friendly area? 2, what does the rent look like in terms of like share of wallet? So Memphis is a good example where, here in the Twin Cities, like if you were to get a loan, right, they don't want more than 40% of your income to go to your housing. If you look at the Memphis statistics, I just saw this last week, about 18% of the share of wallet goes towards the average household income, towards the average rent. So there's a lot of upward room for growth in terms of share of wallet for rent in the Memphis market. So that would be another thing.
As opposed to like New York or San Francisco.
Yeah, where it's like it's already like
70% of your income is going towards rent.
I think some of the Southern California stats, I think we're in the high 30s or low 40s. Like it's pretty significant. It's on average. So it's really hard. So I wouldn't want to get into those, and they're not landlord friendly. And right, so there's a lot of pieces of that. And I think the last thing is, who are the good partners that you have a trust with that can manage these assets? And I think we've really identified a couple of very key people and key organizations in that Mid-South market that we have an existing relationship with, that they're our biggest partners, right? We can come to them, they send us deals. If we find things, they immediately get back to us with guidance on, oh, nope, stay away from here. This is a bad neighborhood. Yeah, hey, think about this as you're looking at certain assets. So we've sort of developed a really good network and a really good vendor service base that allows us to be very efficient. And it also allows us to acquire assets at a price that other people can't get, right? And I'll explain what that means. We just closed a deal in Huntsville in early December. We bought this deal for $600,000 less than the highest offer, right? And the reason was that because we had acquired so many apartment buildings of that size recently in that part of the country, they knew that as a buyership group, we would have an ability to perform. So we were able to actually get a really good price on a multifamily property because our reputation said, I'm willing to take a lower price with these guys because I know they're going to close, right? The authority that we had and the confidence that we gave them gave us an ability to buy something at a submark at a less than, wasn't a race to the top, it was a race to the best, and we wanted to be the best.
And were they using the funds to do a 1031 or something where they just knew they needed to close, and because 600,000 is, it's nothing to sneeze at.
It's a lot, yeah. Well, here's the thing: is when you get these large multifamily assets, a lot of things can go wrong, right? I think more deals fall out of contract than stay in contract, right? There's financing, there's due diligence. Even if all those things work out, can the investor base, do they have the cash to get it done, right? And we had demonstrated that we definitely had the ability to do that. I had another deal in Memphis that was very much like that. It was an investment group out of New York that had acquired an asset out of it had been foreclosed on, basically. And so they acquired it out of receivership. They got it just to the level that someone like me could finance it, because they bought it when it wasn't even financeable. And so for them, as an investment group, every single day mattered to them. Every single day that they couldn't sell it resulted in a lower internal rate of return for their investors, right? For them, it really mattered to sell it quickly. And that was a deal that wasn't even marketed. This ownership group came to the property manager and said, bring me your best buyer who's ready to go, who can get this done. And they said, hey, I know a group, right? Yep. And that property manager gave it to us, completely off-market deal. It's probably one of the few truly off-market deals we've ever done. But that was a thing where they left us a ton of meat on the bone. I mean, it was a fantastic price, but to them it was about expediency, because if they could sell that 1 week earlier, it meant a higher return for their investors, right? And then they could cycle that capital into their next fund. So sometimes there is a huge amount of profit to be had, depending on who your seller is, depending on what their motivations are. And again, that was a pretty rare scenario. Yeah. We happened to be at the right place at the right time. But that one worked out really well, and I think that's going to do well for our investors.
Yeah, but you'll never stumble into that scenario just getting started. You have to be prepared. You have to be there. You have to have the experience. You have to probably get a couple of bumps and bruises, and then those windfalls can happen.
It can, right? And one of the things that we say is this is a team sport, right? I've never done a deal, aside from my single-family homes, I've never done a deal without at least one partner involved, right? It's just... Because I can tell you, I can make any spreadsheet look good, right? You give me any deal, I'm going to give you an awesome return, right? But I can't convince all my partners of that. I can't convince my investors of that, right? So it really comes down to, do I surround myself with a kind of smart, articulate, experienced people that help me get these deals done? And frankly, people brought me along, right? I'm not here today because I figured it out all on my own, right? I got here today because I had other people that were interested in this topic. We took risks together. I had other people that helped me learn what syndication was, sort of helped me follow along and ask questions. And so I try to do the same for other people as well. I do real estate coaching. So if people that want to get into the syndication business, I will help sort of teach them do that. I help teach them in a year what it took me 5 years to figure out, right? So help accelerate that process. It's really fun for me. Whenever I go to Memphis, I usually invite a different group of investors or partners to come down with me just to ride along and just to see what it's like to work, shop existing apartments that we already own, look at deals that we're considering purchasing, talking with the regional managers, looking at the on-site maintenance and doing, unit renovation inspections. And so I try to constantly invite a lot of people down on my trips just to give them a sense of sort of what and how I do it, because I'm never, one of the things people ask me, why do you always help so many people? Are you afraid you're making competitors? Yeah. And the answer is no. The answer is I think I'm making future partners. I'm investing in prospective people that we could do great deals. Maybe they're going to come across a deal and they're going to know who to come to because they know I have a network and know that I've invested in them. And that I sort of enjoy help teaching them the things that I've learned and how we were able to do these good deals over the years.
Yeah, I've met a lot of people that have they're very greedy, holding on to their 100% of nothing because they don't want to do,
yes,
a smaller percent of something, right?
Yes, so exactly.
Yeah, exactly. Cool.
Okay, you mentioned before, there's been some bumps and bruises along the way. Highlight some of that. What are some mistakes that you've made that you could share to help other people avoid?
Yeah, sure. So I can think of two big things that have really influenced the way how I've structured deals. A lot of my earlier deals when I was first starting out were joint venture deals. I would say that the mistake we made early on is that we weren't capitalized well enough. Our goal, in order to maximize your return, you want to put up the fewest amount of dollars into the deal. And I translated that to, right, we don't want any cash cushion, right? Who needs a cash cushion? We'll just make money, right? And that wasn't the right case, right? I think it was being undercapitalized is a terrible position to be in because you're writing checks into the deal instead of the deal writing checks out to you. And so in those joint venture deals, I think that's okay to do. It was a good lesson to learn because I didn't have investors. I didn't tell them they're going to get a certain average annual return on cash return, right? It was just me doing the deal, figuring it out. But it really created this adversity to not having enough cash in the bank. And so one of the ways that's influenced me is that on my syndication deals with my investors, we probably raise a little bit more money than we need just to keep enough cash in the bank. So if a sewer line breaks, or if something happens on the property that have an impact on occupancy, we're not going to sort of be strapped for cash, right? We're not going to have our investors write checks into the deal. We might have to slow down distributions, but we don't want cash to ever have to go the other direction. So that's one thing I really learned is make sure when you underwrite assets, make sure you're very, very well capitalized. I think the second thing that I continue to learn on this is when you first acquire an asset and you implement changes, that first year is always going to be pretty rough, right? Nothing ever goes super smooth. Even if you have the best property management company in the world, you're going to have tenants that just don't like the change. You're going to have new policies or procedures, or you're going to require the tenant to use an online form instead of doing a paper form. And so there's just organic, sort of natural things that happen. And I think just being aware of sort of the patience that's needed in the first 12 months has really helped shaped how I underwrite deals, how I spend time creating expectations with my investor base as well. So I think those are kind of the big lessons that I can have learned out of the.
Yeah, no, that makes sense. Okay.
So let's say someone's listening to this right now, and you're sitting there thinking to yourself, okay, I just had a success in a certain market or a certain area. I just bought a really good deal. I'm super excited about. How can I leverage this deal that I just bought to go out there and have more success? Drew, what is some lessons that you've found, learning from your successful deals where you've been able to amplify that?
Yeah.
And either find more or grow, or what do you do?
Yeah. And your question was around, has someone that just did a real estate acquisition?
Someone just bought a property they're pretty proud of, it's going well, and
Yes.
they're wondering, okay, how can I do more of this? How can I leverage his success to have more success in this area?
Right. I mean, you're in the club. I mean, you get a deal done in a market and you are on the club. You show up on the county list of acquisitions, right? Your name and the address shows up on all these things. Some of the deals I got in St. Paul exclusively came because I bought another deal in St. Paul, and the broker called me up and said, hey, I know you're doing deals of this size. You want to look at this asset? And I said, absolutely, right? And so the success breeds success. It's kind of the law of the first deal. As soon as you get that first deal done, it gives you the experience and the confidence to go after the next deal. And you can start to leverage that in all of your conversations. I remember my business partner and I went down to Memphis multiple times over like a year before we got our first deal done. And it was night and day between the difference of when we bought our first deal in Memphis versus before we had the deal, right? Before and after are completely different worlds because before you buy your deal in a market, you're just a tire kicker. You're just one other person taking up people's time, thinking you're doing them a favor by buying them coffee, right? You're not.
Yep.
With just a plan and an idea, right? As soon as you close that first deal, you are in. You are committed to the market. I'm an existing investor. And here's the phrase you talk to with any broker, any lender. I am an existing investor in this market looking to expand, right? All that phrase right there opens up every bit of doors and opportunity because they know that you are in, you're committed, you have investors, you closed, you executed, right? You have a lender that approved it, you have investors that were committed to it, right? You're in the market, you're there. And so that, just getting that thing done, I think you should shout it from the rooftops, right? You are an existing investor in this marketplace. I'm looking to expand. Here's what I like, here's what I don't like. And I think that's the next thing, that once you are in this market, be very specific with the brokers about what it is that you want to have, right? Mm-hmm. Be very specific, because if you call up a broker and you say, I want to do multifamily investments, and they say, well, what do you want? Well, I could do 8 units, 50 units, 100 units, right? I could do Class C, Class B, Class A. I could do turnkey, value add, right?
And they think, this guy doesn't know what
this guy doesn't know what he's doing, right? Because your goal is to cast in your mind, you're casting the widest net to find every opportunity. But what you're communicating is, I don't really know what I want. I don't know what my investors want. I don't know what I'm good at. And so I would say the opposite strategy. Be extraordinarily specific about your ask. Say, I want to buy this kind of a property of this size in this area at this class. and I want to have execute this. And by the way, I've talked to this person in town, I've talked to this person in town, and I like these neighborhoods. And so having a huge amount of precision feels like you're creating a narrow opportunity,
yourself, yeah.
But you're not. What you're communicating is, I know what I'm doing, I know what's important, and when something fits or something's even similar to that, this broker is going to know to come to you. In the broker density is another piece of it. It's amazing. Unlike in the residential market where there's a huge amount of diversity of agents, right? There's a huge amount of agents that, maybe unless you're Chris Lindahl, I don't know, even like the biggest guy in town, right? He probably commands a single-digit percentage of the market, right? Yep. In the Memphis market, and look at the multifamily assets that trade hands every year, probably on a dollar basis, 90% of all the dollars traded in the Memphis market comes out of a handful of less than 6 people. It's a very, very, very narrow market in terms of who represents sellers of multifamily assets. So don't be cavalier, right? I've worked really hard. I can call any of them right now and they're going to take my call, right? But I've worked really hard to get to that point where I've been able to be specific. I've been able to execute on the deals that I've worked with, and I've been able to be a sort of a good partner to them in those markets.
Yeah, that's fascinating. So have you had success, obviously through those brokers, but in Memphis finding off-market deals? No,
I don't know. I mean, off-market deals still go through brokers.
Okay.
Yep, off-market deals. Off-market is, when people say off-market, usually what they mean is it's actually on-market. If you see it on LinkedIn, it's on-market. If they're calling a couple people, it's on-market, right? Yeah. Off-market is just a cliche. I've done probably one truly off-market deal, maybe 2. It's extraordinarily rare. Yep. And here's the thing is, I want brokers to make money. Yeah. I don't want to go around brokers. If there's a handful of these 6 guys in town, I don't want to do a deal without their name attached to it, because guess what? They control almost all the sellers in that market. And when I want to sell that property, I want them to represent and do a good job for me. So I want my brokers involved, not as a buyer's agent, right? If I'm buying it, I don't have a broker, right? Yep. I have an attorney. Yep. Only the seller has a broker. Yep. But I want the brokers involved. I don't ever want to think I'm going around them, because they control the market. No multi-million-dollar apartment building owner just picks up a call and sells it to someone who sends them a postcard, right? Like that doesn't happen, right? Yeah. It doesn't happen. Maybe that works in your duplexes and parts of the market that you're in, right? But large, sophisticated multifamily owners don't do that, and you need to go through the right channels to develop the relationships that can communicate and advocate on your behalf. Hey, I've worked with Drew on a bunch of deals. He's not going to retrade you on price. He's going to deliver on time. He has a history of this. So I want them to be good advocates for me so I can get properties below the asking price. I don't want to have the best offer. I don't want to have the highest offer. I want to have the best offer. And that's what gets us really good deals for our investors.
Yeah, that's incredible. That's really good.
Yeah. Jeez, that's a lot of stuff to think about. Really cool, really interesting stuff. I'm curious, what is delivering you the best risk-adjusted return in like class of buildings, A, B, or C? Like, what are you most interested in?
Right now I probably think it's B-class assets. I think B-class assets, and I would generally say those are assets built between like maybe 1970 to 2000. A B-class asset is, I think, even maybe like C+. I really like that because it has a couple great characteristics that I think make it give it a lot of resiliency in the marketplace, right? If you look at historical default rates, if the economy starts going down, right, the steel and glass buildings on the Mississippi River, downtown Minneapolis that are trying to charge $4 per square foot, right? Those are like your A class are going to crash, right? Those things are going to go down. If you look at your really like D class assets, like Bullets, like those kinds of neighborhoods, right? Sometimes those you can make a lot of money doing those, but the economy goes down, you're going to have a tough time there. It's that BC class asset that has a lot of resiliency because when the market's doing well, people move up into these B class assets. And when market's doing poorly, people in the A class go into the B class markets, right? So occupancy really isn't an issue in the B class market. I think you have a tenant base that it can be supported by general workforce employees. You work at Target, you can afford a B class asset, right? So there's a whole bunch of sort of it's a very broad demographic. You tend to have a little less turnover in B class assets. You're going to find younger families that want to stay there for 3, 4, 5 years. The A-class tenants, the millennials living in downtown Minneapolis, they're going to turn over every couple of years, right? They're going to be, and turnover is expensive, right? So I want that asset class. I want the stable family. I want the asset class that is presentable. I want it to be safe. It doesn't have to be the prettiest thing in the world, but I think it has a lot of those characteristics. And it also makes it ripe for repositioning, right? If you buy something that was built in 1980, 1985, you're not dealing with aluminum wiring. You're not dealing with cast iron piping, right? And so there's a lot of aesthetics that are really ripe for getting refreshed at that point in time. Kitchen remodels, flooring updates, but yet you're still dealing with layouts that are still pretty modern. Good sized closets and open kitchens and living rooms. So that's kind of the asset class we really like.
Yeah, and is there a unit layout in a lot of these apartments that are most attractive, or I guess can drive the most rents per square foot? Like 2-bed, 1-baths, or 3-bed, 1-baths, or anything like? Is that going to your decision making when looking at these?
Yeah, it does. Mostly a good mix, healthy mix of 1-bedroom, 2-bedrooms is really good.
Okay.
Maybe a couple 3-bedrooms if it sort of fits physically in the building. Sometimes they sit in the corners because that's physically how they can get laid out. Mm-hmm. So mostly 1-bedroom, 2-bedroom mixes. If you have all 1-bedrooms, that can be a little bit tricky. Yep. If you get into 3 and 4 bedrooms, your rent per square foot goes down, your expenses go down, your wear and tear tends to go down. You get a lot more people living in those. In fact, I was just looking at a deal in Memphis.
So wear and tear goes down, or wear and tear goes up?
Wear and tear goes up.
Yeah,
wear and tear goes up. Yeah, your expenses, the wear and tear goes up on these big units. It's really expensive to turn these big units. Yep. A 4-bedroom versus a 2-bedroom, you might get a couple $100 more, but you're not getting for the space. You're not getting that much more. So I do like 1 and 2-bedroom mixes. I just looked at a deal in Memphis a couple weeks ago, and it was all 3-bedroom, 4-bedrooms. And I told the agent, I said, if you could cut these in half, if you could take all these and make these 1-bedroom and 2-bedrooms, it would actually be worth more than it was as 3-bedrooms and 4-bedrooms. Because of how much space it took up, how much you have to heat it and cool it and remodel it, and they're just so big and there's so many people with so many cars. The asset actually would be worth more if it was much smaller on a bedroom basis.
Yeah.
Oh yeah, so just not more units, just
smaller units.
Yeah.
The same thing, smaller would actually be worth more as an asset than it would be as with large all these bedrooms. Yeah,
that's fascinating. Hearing all this stuff from you, Drew, it kind of brings me back because I've gotten to know you over the past couple years a little bit, and when I hear this, or when someone is hearing you, they might think, gosh, Drew spends. He must spend all day and all night doing all these things. And so I want to kind of ask you a question. What is something that about you that people think that isn't necessarily true? That perceptions that they have of you being an investor that you've heard that are not true. And for example, I know that you have a heart for teaching. You're actually a professor, so this isn't just you don't spend all hours of the day investing in real estate. You actually have another job, and you're still this successful. And you're going to your son's basketball practice right after this, and so you have a life that is very important, and you're not going to sacrifice that. Yeah. Where some people think the bigger I grow, the more I need to sacrifice other parts of my life to do this. And I know that about you, but I'm just curious from your perspective, what do you think that people's misconceptions of you might be?
Yeah. That's a good question. I think people think I'm really busy, right? People think it takes a huge amount of work to do all these things. And frankly, it doesn't. And what I tell people is I am an investor of real estate. I don't want a job in real estate, right? I want to buy good assets and entrust them to good people to take care of them on my behalf. But I don't want to actually have a job in real estate. I left my corporate job after a decade just to do real estate, and it worked out great, but I realized I just didn't have enough to do, right? And I didn't want a job in it. So that's why I ended up going back, and now I'm a professor of finance at Bethel University in St. Paul, teaching finance to undergrads, right? Trying to get them excited. I teach a little bit of real estate too, but it's mostly corporate finance work. And I like doing it. It's a chance to sort of feel like I'm serving something greater than myself. It feels like it gives me a sense of sort of balance and cadence. I certainly don't do it for the money. I just like the work, and I like the students. And mainly because when I was a student at Bethel University, it's my alma mater. When I was a student, there was a lot of people that invested in me and that made me instilled in the kind of values and ethics and education and knowledge and critical thinking that allowed me to be successful today. And this is my way to try to reinvest in sort of the next generation, that someone else can be successful and be financially free in order to contribute and engage in the world in ways that is most meaningful to them. And if I can help people do that, I love to do that. It's exciting for me. So real estate for me is not the end all. It is a conduit for which I can engage the world in ways that I think is meaningful. Whether it's being an assistant coach to my kids' basketball, whether it's teaching at my university, whether it's serving on the board of some nonprofits, or being a community member that is sort of engaged and involved. That's the freedom that it creates, and that's the way that I want to sort of leave a legacy. Isn't just on how many dollars have I created for my investors, but what have those dollars enabled me to do in the world? What have those dollars enabled my investors to now do and engage differently? And that's sort of where I see that is the deepest level of motivation that sort of engages my efforts here.
Yeah, very cool. Very cool. That is very, for any of you listening that are outside of Minnesota, I am proud to be a Minnesotan because of guys like Drew. You know, this is where our heart is at. So, very cool. Well, let's, kind of to wrap things up, Drew, do you, any last bits of advice, any, high level for, someone that's, maybe that's one deal in or just getting started in real estate? Any words of encouragement?
Yeah, absolutely. One is, it's not that hard, and I'm not that smart. Like, it is not. truthfully, this is simple math problems. It's about building relationships. If you're good at building relationships, right, these opportunities exist. It's really not that hard. And two, I would say, don't substitute. Like, listening to podcasts is great, but let the podcast inspire you to take actions. Progress isn't reading a book. Progress isn't listening to a podcast. Progress is hearing these things, being inspired, learning something, and then executing these things. Right? Go out and make some calls. Call Eric. Tell him, hey, this is what I want, man. So call him. Take some action, yeah, right? And learn. Continue to learn things, but pair that with action, because you can listen to all the podcasts and all the books in the world. But you go out and chase one deal, and even if you don't get it, you will learn so much more than you could have, given 10x the amount of listening time of a podcast. So take an action, do something, try to move something forward every day. And I think you'll be surprised at the level of how much you'll achieve actually taking more actions than you would just waiting for something to happen.
I think that's fantastic advice. You got to try it, You never know if it'll work. You got to get out there and try it. And you'll stumble, but you'll get on the path at least. So, Drew, thanks a bunch for joining us. I really appreciate it. Yeah. This is great.
Thank you.
That's episode 3, Tangible Assets.
Thank you for joining.
Woo.